Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi. This is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG and Technology podcast series. Today, Professor Aswath Damodaran, Kerschner Family Chair in Finance Education at New York University, will be our guest. So listeners have a high-level sense of our roadmap. We'll start with some background, then discuss the usual. Investors, academics, and business leaders should be able to extract a great deal of value from Aswath's insight. On that note, welcome, Aswath.
Thank you.
Why don't you start with the background?
I'm a teacher. That's the only way I can describe myself. I'm not a professor. I'm not an academic. I'm not a researcher. I'm a teacher. I've always been a teacher. It's been my core, but the way I describe myself. And I've taught for 40 years. So that's, I am a dabbler, which means I don't have deep knowledge or views on any specific topic, but I'm interested in a lot of different things. And in some ways that gives me an advantage because I jump around so much across so many different topics, I can sometimes see something happening and say, I've seen that happen somewhere else. Why aren't you seeing it? So I'm a teacher and a dabbler. That's basically how I describe myself.
I mean, part of what you described sounds like the generalist versus specialist, which there have been books written about, and the advantages of being a generalist in terms of being able to see things that I guess specialists sometimes miss.
The one reason it's unusual in my setting is I live in a space, academia, where if you're not a specialist, you don't have a job. I'm lucky enough that I joined this profession at a time when I got tenured. You can't fire me. I basically can do whatever I want. And I know I've read the books on generalists versus specialists, but this is not a world that is kind to generalists in terms of giving them jobs. We live in a world of specialists, and I'm lucky that I can be a generalist. I can dabble. Every day I get up and I thank the Lord for that, because it's not something most people can afford to do.
Yeah, no, that's great. I don't disagree with you. And I mean, if I look at a lot of Wall Street, I think it's very similar, frankly, where it's a world of specialists.
I think almost every sin in Wall Street can be traced back to the fact that people have no perspective. You got equity guys, you got fixed income guys, you got real estate guys, and they don't even know how to talk to each other. They're just different languages and different spaces. So it doesn't surprise me when there's a crisis in Wall Street, because with tunnel vision, that's almost a given. You're going to get that.
I think that's right. I couldn't agree more. And we've both seen it over many years, which is a good segue into I understand there are two of you, that you have a digital twin. Maybe you could talk a little bit about that and how that experiment's unfolding.
I mean, about 2 years ago, and I was teaching actually a year and a half ago. So I think April of 2024, I was teaching my valuation class when I got a call from a friend of mine, Vasant, who teaches machine learning at NYU. Now he got his PhD in 1984 at Carnegie Mellon. And I asked people to guess the title of his thesis. It was Artificial Intelligence. And I think that's a good start to talk about AI. I mean, we act like AI was invented on November 30th of 2022. That was the day ChatGPT was unveiled. But AI is actually a gradual coming together of two forces in business: increasing computing power in smaller and smaller packages, and insane amounts of data gathered together in one space. That's what AI is. So he called me and he said, Aswath, we built a Damodaran bot. I said, a what? He said, a Damodaran bot. I said, what's a Damodaran bot? He said, it's an entity which has read every single blog post you've ever written. I've written almost 2,300 pages on my blog since September 20th, 2008, which is when I started my Google blog. I'd say it's watched every one of your classes. I mean, I record every class that I teach. So I have 20 years of classes recorded and on YouTube. So you can watch my 2011, 2012, 2013. It's watched every one of your videos. It's read every one of your books. It's looked at every one of your valuations, because all my valuations are shared, because I'm not interested in holding it behind in some secret place. It's looked at everything you put online, and I'm unfortunately one of those people who puts everything online. And I said, okay, so what? He said, it's ready. And I said, ready to do what? It said, ready to do valuation. He said, can you give me 20 students from your class? We'd like to run a contest where every person in my class has to pick a company to value, and whatever company they want. He said, we're going to run a contest where the student values the company and the Damodaran bot values the same company. It doesn't just do valuation, it writes a full report based on what it's learned from my writing style. And he said, I'd like you to judge how well the bot does. And I was terrified. I was terrified because either outcome is not good for me. If the bot does better than every single one of my students, there's a message there, right? There's really no point teaching the class. AI can do it. If the bot does worse than every single one of my students, it's a different message. I share everything online because I'm a teacher. And if somebody, in this case, let's call this entity as somebody, which has read everything I've ever done, watched everything I've ever put out there, is unable to value a company, I have a different problem. I'm not a good teacher. But I agreed to the experiment, and it's been interesting because I've been watching that experiment unfold, and the bots got better over time. That's the bad news for people who think AI is going to go away. It's got better over time. It would get a solid B plus. It is a B plus student, and let's face it, 85% of my class will never be beyond B plus. They get the mechanics right. They get the words right. 90% of sell-side equity research on the street will never be above B plus if it gets lucky. Much of equity research is B minus, B, C plus, and the bot can basically match or do better than it. It does really good at the mechanics and framing your thoughts based on how you've written before. So I wrote a piece right after, a couple of months after I saw those examples. It's a fundamental question that I think we should all be asking. I mean, I have a bot with my name over it. In fact, I have 7 bots that I have traced that are tracking me. 2 are bots that I agreed to give permission to. I gave them access. The other 5, for lack of a better word, are scam bots. Basically, they use my videos. They basically create words, and it's amazing what AI can do. And they go after people's money. So there's a second post that I wrote about the scams that are happening. But the first post I wrote was, hey, there's a bot looking over my shoulder that does a lot of what I do. What is it that I do that the bot can do better than I can? There are a few things that I do that, I'll be quite honest, a bot can do better. One of the things I do at the start of every year is I collect data on every publicly traded company in the world. Sounds like a lot of work, but I have access to Capital IQ, Bloomberg, so I basically create a spreadsheet of every publicly traded company. And then I create this data that I share with everybody else on industry averages and everything from costs of capital to margins to growth rates based on the data. It's a pure Moneyball exercise. I've been doing it for 30 years, and about 10,000 people every day access my website to use the data because it's free. You know what? The bot can do that better than I can because it's a very mechanical exercise. I'm human. By the time I get to day 5, I use about 5 days to update the data. By the time I get to day 5, I'm tired. I make stupid mistakes. The bot will not. It doesn't need a coffee break. It can work 24. There are big chunks of what I do that a bot can do, not even as well as I do, much better than I can, because it doesn't make the mistakes. So the question I ask is, what is it that I do that the bot will have trouble doing? That's the entire post. I don't want to monopolize the conversation. If you're interested, I can talk about some of the things, that I don't know, that I do, that it's going to be difficult for a machine to do. But that was my introduction to the threat of AI coming after me. And I tell students in my class, there's a bot with your name, even though you don't know it, looking over your shoulder. And I would say this of anybody working anywhere, looking over your shoulder at what you do every day. And if what you do is mechanical and rule driven and driven by bias. In other words, you already made up your mind that you want to buy a target company and you have to come up with $10 more than the price. A bot will do that better than you can. So it's actually a signal to you saying you need to add something to this mix that makes you necessary, because if you don't, there will be a bot that takes over for you, and it's going to be cheap, maybe even free for a company that uses it, and effectively replace you. The days when an equity research analyst in in New York was replaced by an equity research analyst in Mumbai, you outsourced it, those days are done. You're not outsourcing to Mumbai or Manila, you're outsourcing to a bot that's been created that's essentially never ages, learns more as it goes along. And if people are not aware of the threat, they're going to be blindsided by it.
So I have many thoughts, but one thought I would just add to your initial straw man or premise. The record low cost of computing is also what I think has driven this. But to your last point, to ask the perennially talked about question, what is the impact on employment then? And how does that impact employment in aggregate? And if all those people who are doing outsourced labor in Manila or wherever you suggested, or are not needed or supplanted or replaced by bots or AI, what impact does that have on society broadly?
I'm not going to talk about other professions. I'm going to make it direct. I'm going to say something brutal about active investing. All of it, from mutual fund management to alternative asset management, 90% of active investing is mechanical and lazy. You know what? AI will take your jobs, and when it happens, nobody should shed a tear. This is a profession that is begging to be taken to the cleaners.
Yeah, well, I couldn't agree more. About 8 or 9 years ago, I co-founded an investment management firm called Move 37, which was predicated on the premise that machine learning and alternative data would replace discretionary managers. And I think you spoke for me when I was head of value investing at CFA New York, or New York Society of Securities Analysts, some time ago. And so, yeah, I mean, to your point, yeah, I'm 100% on board with you on that.
So I want to keep it focused on Wall Street and investing, because that's our domain. I think this is the space where AI is going to make its quickest advances. Of course, software coding so we know that's already happening. But AI is coming. AI is coming because so much of what we do in investing and corporate finance on Wall Street has become mechanical, has become easily replicated by a machine. So I think that it is going to happen. I think that those 20-something floors that Fidelity has on Summer Street in Boston will become 2 floors. The question is, what do you do with the remaining floors? Because I think active investing is, by the time this is all said and done, will be about a third of the size it is today. It might not happen next year. It might happen gradually over the next 10 years, but it's coming.
Yeah, I couldn't agree more. Let's shift gears for a second to ESG. You've written some, I don't know, perhaps controversial papers on ESG. I'm not sure I necessarily disagree, but where do you stand on ESG today?
What a scam. This is the most gigantic scam I've seen pulled on the investing and business community in my lifetime as a researcher, as a thinker. And I'll give you my case against ESG in 4 simple steps. First, if I asked you what do you think ESG measures, or you ask anybody on the street, my guess is people have an answer, right? Based on their biases and what they think is good or bad. So if your thing is climate change, you think, oh, ESG measures companies that are good on climate change, basically high ESG score company. If your thing is labor rights, then you think ESG measure. Each of us thinks ESG is protecting our private social good. My challenge to you is, if that is what you believe, go take a look at the ESG scores for companies coming from the services. So if you're a climate change person, you think ESG is good because it saves the planet. You know, one of the highest ESG score companies, according to Sustainalytics, is British Petroleum. What does that happen? The reason it happens is ESG is this, even the services are not sure what they're measuring because it keeps shifting and morphing to be whatever the mood of the moment is. I remember when Russia invaded Ukraine, all of a sudden, European weapon makers were good companies. How did that happen? Because by definition, and I don't blame the services, our definition of goodness and badness is going to shift over time. So my first problem with ESG is they don't know what they're measuring. I don't know what they're measuring. And we're using these scores as a basis for investing and rewarding and punishing companies. We're asking for trouble. It's become a game, and companies have become very good at playing that game. Second, I've been told that ESG is good for value. I remember when Larry Fink made this statement, I don't know, 2018, 2019, and my reaction is, really? I live in this space. This is all I think about and talk about is value. Where in value does ESG score? Because ultimately, for something to affect value, it's got to show up in one of three places. It's got to show up as higher cash flows. So maybe your expenses are lower. It's got to show up as higher growth, or it's got to show up as lower risk. So I said, this is an empirical question. Does ESG increase cash flows? And the answer seemed to be no. In fact, ESG seemed to put a cap on growth. You can stay a company like Patagonia, which is a good company, but then you're going to be a niche company. But if you're Nike, you can't afford to be that good because you need revenues from all over the space. So it turns out that if you want to be good, you got to accept cap on your growth. It's actually a challenge that Etsy ran into and failed because they decided that they could not be a social benefit corporation and become larger. So they abandoned the social benefit aspect of the corporation. What about cash flows? I don't know about you, but being good requires sacrifice. Building a factory in a higher cost locale than a lower cost locale. If you actually look at the margins for ESG companies, at least early in the process, look like high ESG score companies at higher margins. But this is what I call spurious correlation. It came about because early in the process, ESG tended to look at tech companies as good. They had among the highest scores, and tech companies have high margins. It was accidental alpha and accidental margins because you basically jumped on a bandwagon and those companies did really well, and you claimed it was because of ESG. The one argument that I think people make about ESG is, doesn't being good reduce your risk? In the abstract, yeah, I can tell you stories about how being good could reduce risk. But really, all the stories are not about being good, but about not being bad. My advice to companies is, don't be bad. Don't be bad because you're walking fairly close to that line between what's legal and what's illegal. And if you're Vale and you allow thousands of people to die because a dam imploded, and it is going to hurt you as a business. My conclusion, when I first wrote about ESG, I entered with an open mind, saying, look, I'm ready to listen to this argument that ESG could make you more valuable. But I could not find an iota of evidence backing that up. I found hundreds of papers claiming to back it up, but I have never seen research as crappy as the research in the ESG space because it's written by advocates, not researchers, who start with an agenda. So ESG doesn't make you. Then I said, okay, maybe ESG creates alpha because that's the early pitch, right? You could own an alpha. That turned out to be a complete lie because, again, as I said, it's an accidental alpha. You looked like you were making alpha because you were heavily tech focused. And then again, Russia invades Ukraine and your alphas start to melt away because now fossil fuel companies are taking off. And when the alphas melted away and didn't just melt away, became negative, you had a legal problem with ESG. Many of the people managing large amounts of money are managing other people's money, endowment funds, pension funds. And if you're investing in ESG and you're costing me returns, you have a fiduciary problem, which is one reason BlackRock can never admit to the fact, even if it's true that ESG actually leads to lower returns. The final defense of ESG is, but I want to make the world a better place. Yeah, I do too. But ESG accomplishing that? In fact, I would argue that on every sin or bad thing that ESG set out to solve in 2000. This was born out of a UN document, right? It was Kofi Annan hiring 50 investment managers, tell us how to be good. 2004. Name me one problem that ESG set out to solve in 2004, where we're actually not worse off today than we were in 2004. I did a piece on impact investing, which is a subset of ESG. Much of impact investing has been about solving the climate change, about reducing the carbon footprint. We spent trillions of dollars of impact investing, but to what end? We are just as dependent on fossil fuel energy now as we were 30 years ago. It's true, we're solar power and maybe other but it's come at the expense of nuclear power plants being shut down. So effectively, we're running in place. It's like that Burger King commercial, right? Where's the beef? Where's the impact in impact investing? You can't measure it. It doesn't increase value. In fact, it decreases value. It doesn't create alpha. In fact, you have a constrained optimal. You're going to reduce your returns, and it doesn't do any good for society. So why the heck do we keep it around? And renaming it is not going to make any of these problems go away. You know exactly what I mean by renaming it. The big new word is sustainability. I don't even know what that means. Sustaining what? So basically, it seems like all of these things are born at the Harvard Business School in a strategy department. So let's name something, let's give it a virtuous name, and then reverse engineer the research to make it look better. So I have now I can't think of a single good thing to say about ESG. And I will stick with that. And I am increasingly coming to the same conclusion about sustainability. And when I wrote this for my first piece on ESG, I said, I'm probably going to be tagged as a moral troglodyte, but I'm okay with that. I don't care. And I think part of the problem in this space, that this problem has become so big before we talk about it, is people were intimidated. Saying things were not right with ESG was viewed as a bad thing to do. And I think once discussions become about virtue, especially when you're talking about business and investing, have all the discussions about virtue you want in churches. Even have it in politics, because you can change laws. But in business, when discussions are centered on virtue, nothing good comes out of them.
Yeah. Well, it's funny. I spoke for the AIC, did a paper and spoke for the A, had the same conclusion you did, or one of you have many conclusions. One of the same conclusions, which was one, it's obviously very discretionary, right? Your values are not my values, and you may say tobacco and gambling are, not ESG friendly, and I may say they're absolutely fine. And so that's one point, obviously. And then another point is, I looked at, I think it was also Sustainalytics, and I looked at, I think it was Pepsi and Dunkin' or something, and two different companies, both of which I would argue are not net beneficial to society in terms of sugars and salts and processed foods and diabetes and the obesity epidemic and healthcare costs and humanity and all that. And one of them was rated, fabulously, and the other was rated terribly. And my point was sort of the same as yours, which is, to me, at a holistic level, I don't think either is particularly good for society, but one gets a great rating because, whatever boxes they're ticking, their board composition. Yeah, go on.
Anytime you have a score or a rank, it'll get gapped. It's a given, right? We're ranked as a business school. You know how many of our decisions within business at NYU, how many of our decisions within the school are made based on what will improve our ranking? We'll actually not offer a seat to somebody who's got a perfect GMAT score and a 4.0 GPA and a great work background for the MBA program. You know why? Because we give them a seat and they don't come, the acceptance rate from students drops. And that's one of the inputs that goes into the ranking system. You sit in committees and you see decisions being made on how they will play out in rankings. This is not a healthy process. And the ranking that emerges is more the result of the gaming that goes on than actually making decisions that reflect what the ranking is supposed to measure.
Let's talk about there's so much we could talk about, and we could go for hours, but we don't have hours. Let's talk about the the Mag 7, and because you're the valuation guru, and let's talk about the Mag 7. So I was a portfolio manager at Soros during the first tech bubble with Stan Druckenmiller, George Soros, Scott Besson.
Yeah.
To me, first I'll give you the straw man, and then I'd like to hear your thoughts. To me, it's really 2.0. It's largely the same thing. AI is real. There's no debate. You mentioned it, displacing labor. It'll increase productivity. It's faster, cheaper, more efficient. It doesn't need vacation. It doesn't get burnout. Anyway, so there's all of that. So AI is real. LLMs are real. The impact on work, society, that's all real. But my view is we simply have excess investment, and then we have these similar circular deals where OpenAI needs to buy NVIDIA chips to do processing, is hemorrhaging money, and they can't afford it. So then NVIDIA does vendor finance, just as Nortel or Cisco or Lucent or whomever did 25 years ago. And you have this capital misallocation. You're going to have excess investment. And it over time, initially it'll be just like we overbuilt 5 or 25 years ago, and Amazon was down 90% post the first tech bubble before it went up God knows how many thousand or million percent. So anyway, that's my straw man. I'd be curious to hear what your thoughts are, and if you like to touch on the valuation. So the point is, everything's overvalued because everything's not everything, excuse me, but let me be more nuanced. A lot of these stocks are overvalued because it's just not sustainable as it currently stands. Curious to hear your thoughts on that, straw man.
I'm going to ask you a question, Michael, and it's going to sound odd. So what? What if there's a bubble? Why is that a bad thing? I'll tell you why I'm going to start with that, because
Well, I can give you an answer if you want.
yeah, go ahead, Michael.
Well, it just means that, if you're, let's see, if you're an institutional investor or a retail investor, or you're, investing your pension or your IRA or your 401k, and I'm not wrong.
But let me pause you right there. When did you make this investment? Did you make it in 2018? Did you make it in 2024? Because I think we need to isolate who will be hurt when. So I'll concede up front, there is an AI bubble. There is an AI bubble because it is a feature, not a bug of big change. There was a PC bubble in the 1980s. I'm old enough to remember that. There was a dot-com bubble in the 1990s. There was a social media bubble. You know why we create bubbles is because anytime you have big change, people get over optimistic, and overconfident people tend to start businesses. Overconfident people tend to be VCs, and the essence of overconfidence is we overshoot. So I'll concede there's a bubble. And when there's a bubble, there's going to be a correction. We can call it the bubble bursting. And when that happens, you're going to wake up and your portfolio is going to be around 35%. If you invested your money in 2024, I agree with you entirely.
Okay.
There's pain and damage. But if you built up to it over time, I would suggest you look at how much money you had in 2019 and ask yourself, where are you now versus 2019? And I think that's the first part of this is I own 5 of the Mag 7, which sounds contradictory because I just said there's an AI bubble. But I bought Microsoft in 2014. I bought NVIDIA in 2018. In fact, I sold my last piece of NVIDIA last week when the stock hit 210. None of these stocks were bought last year, 2 years from now. Are they overvalued today? Yes. You're saying, why didn't you sell them? 2 reasons. One is I live in California, which means my taxes are going to be on top of the federal 23.6%. You add the state tax, you're at 34%. So they're going to be overvalued by at least 30% for me to take it. The second is I'm willing to let it ride. I'm willing to give up a chunk of my gains because I step back and think in terms of framing. Where did I get these shares? Where am I today? Because there are 2 things driving the AI bubble. And it's not the interlocking investments. The first is greed. We all want to make higher returns, and I share that. The other is FOMO. The biggest, people often blame retail investors for these bubbles. They're not even in the landscape. The biggest drivers of bubbles are institutional investors because they're terrified of being left out of the party. That's what's carrying these stocks, is portfolio managers who are terrified of not having the Mag 7 in their portfolios now. And they're all late to the party. They didn't join in 2018 and 2014. They joined in 2023 and 2024 because they were afraid of being left behind. But they're terrified of not having these stocks Because if these stocks keep doing what they've done for the last decade, not just for the last year, at a year from now, when these portfolio managers get evaluated against other portfolio managers or against the index, they're going to come in short and they say, look, I can't afford that. So what's driving the momentum is FOMO and portfolio managers being afraid of being left on the sidelines, but it is a bubble. There will be a correction. There will be pain. And in this case, the pain is going to be worse than in the dot-com boom. And here's what. The infrastructure investment for the dot-com boom was a fraction of the infrastructure investment we're seeing for AI. By infrastructure, include the data centers, the chips that go into the data center, the power that goes to the data centers, the data that they're acquiring for the data centers. We're talking about hundreds of billions of dollars being invested in infrastructure. Hoping for what? An AI product or service business that's going to be trillions of dollars. Right now, that business is tiny. It's if you're lucky, it might get up to 100 billion in terms of total revenues from actual AI products and services. We're building into a dream, and as always, that dream is too big. The underlying reality is true. There will be AI products and services, but they can't be $5 trillion. There isn't enough of a market for that. That's what eventually will cause the correction, is that reality check. But one of the questions to ask about any bubble, AI or otherwise, is remember the old legal sayings, let's stipulate there's a bubble. Let's all agree there's a bubble. What is the best course of action, assuming you believe you're in a bubble? The response I get from most people is just sell everything, sell short, do what Michael Burry is doing. Is it though? I mean, if you'd listened to Alan Greenspan in 1996, when he talked about irrational exuberance in the dot-com boom, and you sold all your shares, I think it was December 3rd of 1996, you know what? You'd have been worse off than somebody who did not listen to him, rode the boom up, got busted, and stayed in. One of the problems with diagnosing a bubble is there's no obvious action that comes out of it that you can take. And we live in a world where there is no obvious safe place to go. The old days, it used to be you think the US markets are in a bubble, go to Europe or go to Asia. Those days are done. We're all heavily correlated, every market. You say, what about another asset class? What about real estate? What about gold? Take a look at real estate and gold. They're at all time. You're jumping from one bubble to another bubble to another bubble. And that, I think, is what's making investing so much more terrifying. There is no safe place to go. We've globalized. Congratulations. With liquidity, we've globalized. We've taken every asset class and made it securitized. And in the process, we've made everything move together. So my big challenge as an investor, and I don't give advice to other people, is how do I create a portfolio that is at least mildly protected? And the answer is there's no obvious place. So you got to go back to cash as your mechanism for slowing the process down. And you have to do it gradually. You can't sell everything and wait for the correction and then get back in, because my guess is that could be 3 years from now. It could be 2 years from now. And then even if the correction happens soon enough, are you sure you can get back in? I know people who sold before 2008. These are the people we've labeled as gurus. They saw the housing crisis coming. They saw the market crisis coming. They sold their shares in 2006 and 2007. Great, right? But here's the problem. Many of them, and I know a few of them, have never been able to get back into stocks since. Because once you get out of stocks and all of your money is in cash, getting back in becomes this huge, huge choice to make. And psychologically, they're trapped. They become eternal doomsdayers, because they made their reputation and money by calling one doomsday, and they believed their own hype. They thought it's because they were clever and they had foresight, when in fact they just got lucky. And I think that's part of the problem. Is AI is in a bubble. Mag 7 is probably overvalued, but there aren't segments of the market that are obviously undervalued, right? This is a market that's been borne up by that sentiment and money going into stocks. There's no obvious segment of the market that I can point to. Oh, go to that segment. It's cheap. That used to be possible 30 years ago. Invest in your 30s. Maybe they'll be safe. You know what? If there is a Mag 7 correction, I can guarantee you there is going to be a correction in utility stocks and industrials and materials, because when money flees the market, it doesn't selectively flee sectors, it flees the market.
What about, that's a good segue into crypto, blockchain, Bitcoin, that whole ecosystem. I suspect know what you're going to say, but again, I guess I give you a straw man. I mean, to me, Bitcoin is a bit like gold, but
Yeah.
or maybe
It's millennial gold is how I've described it.
right. It's got no present value of a future stream of cash flows, right? So how do you value it? You can. It's worth
You
what
can't
people
value
will
it.
pay for it.
You can only price things. It's a collectible or a currency, depending on which if your story for Bitcoin is this is going to be the currency for the future. Bad news, currencies can't be valued. They can only be priced. That's what an exchange rate is. And the problem is Bitcoin is not a good currency. It's a very inefficient currency. This morning I went to Starbucks, picked up a grande cappuccino. If I tried to pay in Bitcoin, assuming Starbucks accepted it, here's what would have to happen. A miner in Ukraine would have to get on a computer and guess a 9-digit number to see. This is no way to build a currency, but this is the problem when you build a currency entirely on the presumption that you can trust no one. It's not a good currency. So if you're investing in it because it's going to be the currency of the future, I would give up on it. But it could be a collectible. It has one thing going for it as a collectible, scarcity, which is this natural limit of 21 million that's been built into the system, assuming Bitcoin remains the crypto of choice. But scarcity alone doesn't make for a good collectible. I remember people who bought Beanie Babies. Guess what they're doing? They're up in people's attics. They're worth nothing. You can't even give them away. You need enduring demand. That's what makes gold special, right? I mean, I wrote a piece on gold a few weeks ago, and you can trace gold back 6,000 years.
Sure.
People have always attached some demand value to gold. Gold is an enduring demand collectible. And my problem with Bitcoin is not that it's not a collectible. It's clearly a collectible. People have bet on it. But the question is, what if we have the equivalent of alchemy? Alchemy, and thank God for gold investors, has never worked. If it had worked, gold would drop to zero, right? Because we can convert anything to gold.
Yeah.
But you could have the equivalent of alchemy in Bitcoin, where some other crypto collectible replaces Bitcoin. And if you put your entire pension fund into Bitcoin today, what if it's the next Beanie Baby, not the next gold? So I'm not one of those who dismisses Bitcoin out of hand, but I don't think it's a good currency and I don't think it's a great collectible. And there's another feature of Bitcoin that I think makes it a bad collectible. A good collectible actually holds its value during a catastrophic crisis. That's what made gold a good collectible. Not small crisis, big crisis. It holds its value. Sometimes it goes up in value. You know that every crisis since 2008, Bitcoin has behaved like very risky stock, not like a collectible. Stocks are down 40%, Bitcoin's down 60%. In fact, if you tell me what Bitcoin did today, I can probably guess what stocks will do today or have done today. That's not what a good collectible does. So my problem is it's not a good currency. So far, at least, it's not been a good collectible. I'm not spending $99,000. I think it dropped below 100,000 today of my money to buy Bitcoin. But if you want to do it, go ahead. It's a trading game. Mood and momentum, get out before the mood shifts. Because that's been the history of Bitcoin is good traders can make money by detecting those shifts in momentum.
What about, let's see, in the remaining time, do you have a view on where the most interesting investments are now or what they are, or you don't like to give investment advice?
Interesting as in because at
Compelling,
this point,
attractive, risk-adjusted.
we live in a very richly priced world, and that's what I say. So be realistic about returns. So if you have clients who want you to make, if you're a VC or a PE, stop going around promising people 20% returns. This is delusional. This is delusional because you can't deliver those returns in a world where stocks are priced to earn 7.5%. That's the implied expected return on stocks globally. I think people have to bring down their return expectations, which if you're a pension fund or an endowment fund is going to have ripple effects. It means people have to set aside more money to cover the retirement needs because markets are not going to deliver the kind of returns they would have 20 years ago or 30 years ago. So I think this is the time for realism, bringing down expectations because in a richly priced world, those expected returns you're going to get are going to reflect the rich pricing.
What advice do you have for other allocators or investors? Any?
Don't overreach. And this comes from my previous point. Too often people go chasing after something because they think it'll give them double-digit returns because my equities are going to make only 7%. Let me try something. And I think that's, I know a lot of your listeners are in the alternative investing space. For 20 years, alternative investing and premier, I'm going to talk specifically about VC and PE, has sold itself to endowment funds and big pension funds and family offices on two promises. One is that it's likely correlated with public equities. I've seen the correlation matrices that are used, right? And the second is that there's a greater chance of alpha in VC and PE because you're working in the private market, not in the public market. Both are either lies or have become lies. On the first one, the correlation, the only reason the correlation between PE and VC and public markets is low is because the way in which PE and VC marks up their portfolios at the end of every year is a lagged effect. I'm not saying that Ernst & Young and Deloitte and KPMG are committing fraud, but appraisals and valuations of privately owned investments, we know lag the market. So 50% drop in the market will play out over 3 years in the private space. It brings down the correlation. If you truly try to go sell your private holding during that period, markets are down, guess what? You're going to be down 50, 60, 70% as well. So the correlation is actually pretty close to 1, in my view, between PE and VC and public equity. On the alpha space, there was a time when private equity investors earned more than the market. I was there at the birth of PE, right? KKR and Blackstone when they emerged in the 1980s. Did you beat the market? Yes, because you were the only player in town. You were able to buy private businesses at a significant discount at what a diversified investor would pay for those same businesses. You were just arbitraging risk differences. Those days are done. We have too many private equity players. And you know how it plays out. The returns on private equity look very much like the returns on public equity now. There are few private equity investors who manage to beat the market, but just as in mutual funds, there's no sustainable returns, no correlation across time, which means it's like, private equity is looking very much like public equity. The only problem is you're taking a bigger chunk of my money when I invest in private equity in terms of transactions costs and management fees. And for what? Same thing can be said about VC. The retirement VCs basically had the startup business to themselves. Today, public equity has entered that space. I look at Uber and I look at the investments made in Uber before it went public. Fidelity was there, T. Rowe Price was there. And of course, the Saudi investment fund was there, which is usually a sign the market is topping off. The Saudi investment fund enters. Might as well leave the market now. Both the spaces are getting crowded and it's showing up with the alphas basically going to 0 and below for private. So I think that with endowments and funds, I would say, you're going to be promised don't fall for this new asset class argument. There are no new asset classes. You can take an existing asset and kind of slice and dice it and offer different cash flow claims, right? So there are no new asset classes. There are new ways of presenting old asset classes. And when you're promised 5, 6, 10% more than what you should be making, those alphas, the person making the pitch is either a fool or a fraud. If you're realistic and you really are beating the market, it's going to be by 2 or 3% over time. And you got to tell me what you bring to the table that allows you to make it. So fall less for historical track records because there are people out there who either have hypothetical records, which is a complete fraud, or actual records where they beat the market. Might be good to read Mike Mabuson's book about how difficult it is to tell the difference between luck and skill in this business. So I would say, tell me what you bring to the table rather than your historical track record, and I'll make a judgment now whether it's something that I want to bet on.
What about the recent administration discussion on either diminishing or eliminating quarterly reporting? I suspect I know where you stand, but I'd be
Yeah.
curious to hear.
I mean, I'll take the part of that argument that I think is true, which is there's too much gaming around this quarterly earnings reports. I mean, the lead up to it and the guidance that comes out of it and the post report kind of analysis. I think there's a lot of gaming by the companies, by investors, by analysts. But I think taking it away is not going to reduce the gaming. One of the things I've learned from markets is taking away a disclosure just replaces it. It creates a vacuum where the market steps in and makes up something, right? Estimates disclosures. No news is never no news. No news is often bad news because people fill in that vacuum, or it can be good news. So my pushback is removing quarterly reporting is not going to make any of the problems that they claim exist go away. They might actually make them worse. I would actually, and this is going to go counter to what most people believe, I would take away this guidance thing. I think it's becoming a huge gaming of the system. Just put out your quarterly reports. When you have your earnings report, just talk about what's in the reports. Don't give me all this stuff about what the reports are supposed to mean. I can frame the data myself. Remove this guidance part, because I think that's a big part of this gaming in the system is companies providing guidance and trying to reset expectations. I would rather just you put out the quarterly reports, put out a short earnings release where you describe what's happened. Of course, you have to be open to questions from reporters and why did the number of users drop off? But let's go back to basics to the reporting rather than the framing of what's in the report, which managers often do to not to great. It's not working anymore, right? Everybody provides guidance. And then now one of the phenomena we're noticing is companies that beat expectations, seeing their stock prices go down, which tells you that analysts have lost control of this process as well. So I think that the gaming around earnings reports has become a little excessive, which might be a sign also where we are in the market, right? We have nothing solid to talk about. It becomes about what did the NVIDIA report include, and then you react to what's in the report rather than the overall fundamentals of the company.
Other than your own fabulous books, what's either a favorite book or a good book that you recommend? And this could be beyond finance.
Yeah. I mean, I've already mentioned Michael Mabuson's books. I
Yeah.
love Michael's work, and I love his work, not just in his book, but his reports that come out of Morgan Stanley. He recently put out one on invested capital and capital allocation, which happens to be one of those areas he's fascinated with. I love his books. I also really like Morgan Housel. And you'll notice these books both are books in a sense that talk to investment philosophies, because I think there are too many books that are about investment metrics and mechanics. And the problem with those is they claim things that can't be delivered. I think that what we need is to step back from that edge of looking at details and looking at big picture and saying, what am I trying to do as an investor in the market? What's my end game? What do I think about markets? And books that encourage you to come up with your own conclusion about markets are the books that I enjoy reading, because yeah. But I'll also make another confession that's going to sound weird. I think we read too much. We listen to I mean, we fill our days with what other people think about markets, what other people, and there's a problem there, because I think we're not giving ourselves enough space and time to stop and think about what's happening out there and come to our own conclusions. I encourage my students to read less and think more. Take a break from, leave your smartphone at home. Just take a walk for 30 minutes, preferably with a dog because that keeps you distracted. And just think about what was the news story of today? Why would NVIDIA take a position in OpenAI? What's with this cross ownership thing? Right? Because this is not there's clearly something going on where the big players in the AI game are creating interlocking ownerships. You're saying, what is it that they're trying to do? This can't just be about excess cash lying around. I'm investing something. It's not accidental. You can listen to what other people think it is, but I think this isn't rocket science. But think about what is it that they're trying to do? And every day there's another question that comes in. So for the AI bubble, I would encourage you to think about what is it that what is AI? What are we trying to do with these data centers? What's the end game? What is it that these data centers are supposed to produce? Would I buy an AI product or service? So rather than the abstract, now I get hit with at least 4 or 5 offers on AI stuff on my existing product. Would you pay $3 more? So far, my response on every single AI offering I've got is, it's neat, but I'm not paying a penny for this. My Apple Mail is now neatly sorted into these 5 boxes. I like it that they've taken the emails based on my history and said, this are your primary emails. I like it. But if Apple said, would you pay $5 a month for it? My answer is no, which I think is going to be, can be extrapolated. AI in the consumer space is not going to be a huge business. It's going to be a lot of neat stuff that all of us get, but it'll be like your GPS on your phone and ask you how much you pay for it. The answer is nothing. There's a lot of neat AI stuff. AI business to business, different game.
Yeah. Well, look, I think we're roughly out of time, but that was a great way to wrap it up. And I think I don't disagree. I think the opportunity for AI is in the enterprise, not the consumer. But look, we'd like to thank you for that fabulous and interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of our more thoughtful academics or teachers is thinking about and how we all may benefit from it as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again in our next episode when we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you.
Thank you.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.